Hello and welcome everyone. It is a great pleasure that you're joining us for today's Investment Talk Germany, Investment Strategies and Outlook for 2021. In comparison to last year and due to the current situation, globally speaking, all markets are in turmoil. Needless to say that all investors are on the outlook for safe havens. This being said, we all need to ask ourselves, what role does the German real estate market play in the investment strategies of international investors, and how has the assessment of the market changed as a result of the events of 2020? Today's digital talk will be moderated by Kadel, Head of Capital Markets at Colliers International. Thank you for being here and inviting this very interesting round of guests. I shall hand on the reins to you in a second. Just an information for our participants. We will conduct a survey in the process of this webinar, and you will be asked to contribute your opinion, but we will let you know how this works later on. If you want to contribute your questions to the Q&A session that we've prepared for you later on, you're more than welcome to send them to us via chat. Now, without further ado, Mr. Kadel, the stage is yours, and we're looking forward to your discussion. Please.
Thanks very much, Ms. Sakelario, and a very warm welcome to the audience participating today. To make the themes a little bit more crisp for you, the questions we will answer here is Germany a market to be active in the next 12 months for you? What's the outlook? And what to buy, what to sell? We will explore these questions with a very interesting set of speakers today. Looking at Germany from a rather global investment perspective. Proud to welcome in today's What's Next session. First of all, Dr. Claus Becher. He is Head of Real Estate Fund Management at Deka International Retail Funds International. Claus is native German, so quite familiar with the markets by nature. But he also looks over the investment strategy, including the global markets Deka invests in, including APAC, the US, and EMEA. So quite exciting to get his view to this. We further on have Ian Williamson. Ian Williamson is fund manager at BlackRock, the largest global asset manager by AUM. Ian focuses on European real estate investments and brings in a rather US Anglo-Saxon view on strategies and implementation. Notice here that BlackRock is always very much focusing on local offices and implementation, so they have a very deep knowledge also of the local markets. And likewise, very pleased to welcome Sebastien Abascal in the panel. Sebastien is representing GIC, the Government of Singapore Investment Corporation, and he's responsible for transactions in core continental markets. GIC was the first sovereign wealth fund to directly go into European real estate. I think it was in the 1980s. So from our experience, also very active as an Asian investor, very diverse in terms of investment styles, and even through difficult times like we have nowadays, still active. So also Sebastien is born in Europe. He will bring in the Asian view on our subject. So very excited to have all of you in this panel. So let's start maybe first of all with a little bit a bird view on Germany from a portfolio management perspective. Sebastien, geographically for GIC, Germany was once quite far away. Now you're very familiar with the market. But why is GIC still investing in German real estate? How is it compared to other markets? And what are the characteristics for you on this market?
Well, first, thanks, Christian, to have me here. I'm glad to be joining this talk along with this great panel. As you mentioned, GIC has been investing in real estate since a very long time, and has been in Europe since the 1980s. And we run a global portfolio, and as part of this global portfolio, diversification is very important. And Germany, being one of the strongest European economies, has a key role to play in this portfolio. It's true that historically, we started with a very small exposure to Germany, and in the last couple of years, we've tried to ramp up our exposure. And despite the uncertainty in the environment, in light of Germany remaining a strong, a stronghold in Europe, having coped very well with this unprecedented situation. Germany will remain a key focus for us, where we intend to grow our exposure.
Okay, great. And Klaus, maybe over to you. Given that Deka is domiciled in Germany, of course, you're probably heavy weighted in German real estate, but like GIC also, you went abroad quite early, so you can choose, you go to Japan, Australia, or Berlin. And how does Germany fit into this, and what does it stand for in your view?
Yeah, thank you. The first thing is that Germany, of course, is a stable market, and was always a stable market and will always be, in our opinion. It's second, of course, our home turf, so we know quite well where to invest and where we feel well. But I think the main point of strength of Germany is that it's more diversified than the other big countries like UK, which is very focused on London, or like France, which is very, very centered on Paris. We have, of course, Berlin here, which engaged to be a very, very strong market, a newcomer, when you want to say that. And that's the only involving pounding market right there, plus very, very stable ones, which were always strong, like Frankfurt, Munich, Hamburg, or so, which means that we have a very, very diversified position here to make an exposure. And last thing is, of course, that our funds are globally invested, but of course, Germany is an investment market, which has a specific percentage of the income stream. So just to be not underweighted, we of course will always have to invest here.
Okay, great. Then over to you, Ian. You mentioned fund focusing on Europe, and normally US money is rather looking for value adds. Yeah? You mentioned a core fund, interestingly. How is the position of Germany in the global perspective of BlackRock? And are the risk return profiles adequate? And how do you deliver those investment outcomes to your investors?
Yeah, thanks, Christian. And firstly, thanks for having me as well. So much as you mentioned the Anglo-Saxon approach, I actually lived in Paris for 10 years, so don't let the English accent fool you. We at BlackRock obviously are a global asset manager, but as you mentioned in your introduction, we do have a very local presence. So Germany, for example, we have a real estate team of 10 people, and that's run out of offices in Frankfurt and Munich. So in terms of how we think about this, really it comes down to investment solutions. Our two primary ones are core and value add. As you mentioned, I run the core fund in the Eurozone. And in terms of your question on where does the capital come from, it's really two very different capital sources. So for the core end of the spectrum, it's mainly euro-based capital. And then we see more at the value add, the higher risk and return end of the spectrum. It's more cross-border capital, so particularly North American capital. To your question on Germany and where does this fit as part of, in particular, a core strategy, well, you know, everyone on this panel and in the audience will know Germany has very strong fundamentals. It's stable, it has lower volatility, it's liquid. It has higher transparency, although some of us who remember the famous one-page introductions of agents will disagree with that slightly, but it also offers diversification. So I think really in terms of what it provides to a core fund in the Eurozone, it's really the backbone of what we're looking for. It's lower risk, it's lower return, but on a risk-adjusted basis, it still provides a very good part of the portfolio.
Interesting. Thanks so much. Yeah, to go into those fundamentals, I would like to move over to show you actually some slides. As for the ones who are not aware, we annually issue a report. It's called the Bias Guide. This is supposed to give international investors a view on the market, what's happening, and the most important regulations, which were kindly edited by Clifford Chance. Also, thanks to all our 19 research analysts who are working on this in Germany. So I would like to show just the excerpt of this, and we can discuss further on this basis. I will go into the slides. So here showing the fundamentals. As also said by you, Klaus, it's a diversified market. It's polycentric. What you see on the map, but interesting from the fundamentals, you see on the right-hand side chart, the upper line is kind of like the GDP development over the last 30 years. So very, very stable. Of course, we don't have a Chinese kind of like going up, but it's on the lower side, sorry, the blue line, the dark blue line, it's going quite stable. And the upper line was the unemployment rate, which actually was decreasing since 2006. As I studied, actually the 4% what we have at the moment is kind of like where everybody from the professor would have said that's kind of like the best you can achieve. We had in the 60s actually 0.7%, so it's actually possible to even succeed this, but you see very much stability. And on the chart below, you see on the upper line, it's kind of like the top rated prime office yields you see there, which went down in the last 10 years from 5 to about 3%. But you see on the lowest line, the government bonds, how they kind of like been traded now in a negative way, so that you have a risk premium for real estate, which is still about 300 basis points, which is quite high, and compared also to global markets, which probably is an incentive for a lot to invest into this. That's quickly, the next slide shows the transaction volume. So over the last 15 years, we see on the yellow line is kind of like the yields which went down, and the blue bars are the kind of like what was the transaction volumes. So before 2006, 2007, the normal rate level was quite much lower than the 50 billion we had. You saw after the recession, the financial crisis in 2009 to 2008, it took very long until we get again to this level of 2006 to 2007. But interestingly, if you see Q3 2020, we are now at 41 billion in Germany, and we think it will definitely exceed the 50 billion, which is a very, very high level, even through the biggest crisis. And you saw it before in the fundamentals, it was a bigger hit than during Lehman we had, but with the expectation that it recovers very quickly in 2021. So let's go to the last one, just to bring this in, which shows kind of like the inflows into the market. So foreign capital going into Germany. So if you see that, we have Americas here, how much is going into it and what risk classes were covered. You have the European out of Germany coming into Germany, APAC and MENA Africa. We can see that, like, if you go to the total stats, so far we had about 42% foreign capital in the market. To prevent, if I looked at, let's say, the last 4 months, it was rather German dominated. But however, it shows there's still inflow from outside of Germany. And interestingly, as Americas went down, APAC was very, very low this year, only 0.3 billion there. But Europe kind of like was 9.4 billion compared to the big transaction volume. It was the whole transaction volume was still very high, and MENA Africa even increased. So it's a market still where international capital is flowing in. So having this kind of like seen, I would like to bring in one last step, which is kind of like where we are compared in Europe. So if you saw, we had 41 billion transaction volume for Germany. France had about 20 billion, and UK 30 billion. So we were double of France and a third higher than UK. And I would like to give this over to the audience to make this survey. What do you expect will be the most active investment market for the next 12 months in Europe? Ms. Sakelario, can you start the poll on this one?
Definitely. Here we go. So all participants are able to pull their vote right in. Oh, that's interesting. I can already see a lot of votes coming in. Thank you for that. Please keep on voicing your opinion. We will leave the vote up for another 10 to 15 seconds, but almost all of you have cast your vote. So another 5 to 10 seconds. All right, and we will be closing the vote in a second, sorry. Here we go. All right, everyone's cast the vote. Okay, and now I will be able to broadcast that for you. Here's the result.
Okay. So quite clear. At least the audience is expecting a lot to happening in Germany, much more than in these other markets. Yeah, maybe over to my panelists. Ian, what do you think? Do you agree with these results? Are you also focused more activity now on Germany this way?
Yeah, I mean, not wanting obviously to cast a shadow over your poll, I would say it's a pretty stacked audience, but for a good reason. So, you know, I think I agree to a certain extent. We are investing in all three of these jurisdictions for our core and value add funds, but that's through different vehicles. So in the UK, we have the largest balance fund in the space. We have a long lease fund. I've mentioned the Eurozone core fund and also the value add fund we have across Europe. I think really it's very different investment styles. So taking the core in the Eurozone, it's really an income driven approach. We are investing in strategies of what we call core income, enhanced income and transitional markets. Maybe just expanding very quickly on the latter two. Enhanced income is taking on some vacancy, it's taking on shorter duration leases and being able to asset manage those and execute on business plans. And I think transitional markets really is looking at areas where we believe there'll be improvement in those markets over time, and that will drive returns. So I guess, Christian, back to your question, yeah, absolutely, we will be investing in all three in different shapes and forms, and we see opportunities in all three, but not playing down the German bias on this panel.
Okay, and
I mean that in a nice way, not a bad way.
And yeah, maybe to you, Sebastien, do you agree with this? You normally go rather an agnostic way on asset classes, risk class, and everything like that. What is worth to search for and what to sell in the next 12 months?
Well, I'm not surprised, you know, by the survey, partly because I suspect that there is a big German audience, but also because I think that in this, you know, uncertain environment, you know, Germany is faring very well. I mean, UK has a lot of uncertainty, and on top of the global macro uncertainty has, you know, this issue of Brexit, and has been historically a very deep European market. And for people who can't invest in UK because of this uncertainty, I think the next probably deep market to look at is Germany. You know, the other panelists have been mentioning some of the characteristics of the German market about, you know, the fact that it's very deep, offers very large transaction volume, the fact that historically has been fairly stable, and is also polycentric and, you know, offers a good diversification in itself, are characteristics which are very attractive. So I think that, you know, a lot of real estate investors are going to look at Germany, and that's why I'm not surprised by the result of the survey. And when it comes to us, you know, we keep looking at the market. I mean, the flip side of all the attributes that we've been mentioning is that it's a busy market, it's a crowded market where domestic investors are very well equipped to invest, and therefore it is competitive. I think that it was Ian mentioning this, that the fact the market is probably delivering you know, low absolute returns, but we look at it, you know, in the context of the volatility and the risk, and Germany has been fairly stable. So for us, we look across the risk spectrum, so we invest from anywhere to core to more opportunistic strategies. As soon as we pivot towards more active strategies, finding the right partners on the ground is key. And another attribute for us of Germany is that it has a very large bench of very good partners. And so we are very keen to establish those relationships and be able to, together with this local presence, deploy capital in strategies that we wouldn't be able to implement on our own. Maybe the last component that goes along core value add / opportunistic investing is we also invest in platforms across sectors, be it hospitality, be it logistics, and different asset classes. And we think that this environment is probably going to create some opportunities for us where maybe our long-term capital can support and also help develop further some of those platforms. So we are very excited to look at some of those opportunities.
Great. Yeah. Klaus, on your side, probably the same like Sebastien. More competition is not good. Yeah, it makes pricing more expensive. What is a strong buy, strong sell for you in these markets?
Yeah, in fact, disappointing results of this poll. I would love to have another country in front, but in fact, I'm not surprised for everyone. When we speak about the Deka funds for themselves, which I manage or which I oversee, is our global fund has already its share of Germany, and they won't expand there much more. It would rather be more in UK, for example. The Metropolitan Fund I'm looking at, we are already in UK and already we are in Germany, so we might more go to France. So this is a specific diversified theme where we are in the moment. The third thing is, speaking of Germany, I think we have to accept that of course, we will find sooner or later the results of a recession over here, and this will have some impact on the rental market on one side or the other. And that means on the other side, we have support from the very loose monetary policy. So no one knows very much to which side the capital values will go. So this is some kind of a plateau building, which differs a bit to the last 3, 4, 5 years, where we have a specific trend going on, which was upwards. And now this trend is broken. Now we have a plateau, and there's a chance of going up and going down. No one knows. So I think investing in Germany in the moment is a point what you can do, but you have to look very, very careful where is in risk exposure and where you are able to raise value, or you will have to prove to find some losses. And that is, in fact, the main thing of investing in Germany. I would love to invest in Germany, but very, very specific. And then it depends what Sebastien, also Ian said, it depends on your risk appetite, what kind of risk is possible to add to your portfolio.
Mm. Yeah. So it means,
Christian, if I may, Christian, if I may, just picking up on that as well, I think those are great points. And the point Sebastien made about the UK, absolutely, there is a lot of risk around the UK at the moment. The interesting thing, though, probably on a relative basis, is that's reflected more in the pricing at this point. So at the moment in time when that risk is reduced or taken off the table potentially, that could be a very interesting opportunity for people. And if you compare that on a relative basis to maybe some of the more peripheral countries in the Eurozone, it feels like that's not priced in as much in the Eurozone in the periphery as it is maybe in the UK. So not wanting to detract away from our theme of Germany, but just an interesting point to notice there.
Yeah. But do you think, Ian, are valuations adequate in Germany, or do you doubt a little bit on that?
I think valuations are always what the market will pay for an asset. So as long as your value is reflecting the market, then absolutely. I think what's interesting and maybe answering the question a different way is how people are pricing risk at the moment. I definitely think there's some parties, maybe domestic capital, maybe asset allocators, insurance companies, who are not pricing risk the same as other market participants. And so to your point, Christian, in that sense, are people pricing risk correctly at this moment in time? I hesitate that they are at times. And that's not to say that, people should be anti-risk, but it's taking the right risks and pricing them correctly and being able to execute on them. So I think, you know, that's where we try and avoid competing with people who are not going to price risk correctly, and therefore, you know, those are the people, I think, when the famous saying of when the tide goes out, that the swimming shorts will be around their ankles.
Okay. Klaus, but back on this point, so you said it's shaky if we have a plateau now and maybe rental level goes in the other directions. So how do you behave then? What's your strategy then to get around this?
Yeah, it depends on which fund we speak of. When we speak about the bigger funds that can bear more risk, and when we speak about my small baby funds, then of course they have go to the more stable side of the risk situation. And unfortunately, and that is also a thing what Ian said right now, is that in the I guess that in the future or next year, next coming month, a 10 or 15 years lease contract will absolutely be value as gold, and so duration is key, because that is just a spread game, which you just mentioned, that the spreads are 3% towards the 10-year bond yield. So you don't get any income of it, but you might get you some value on it. On the other side, for the fund who can bear risk and choose and differ the specific risk, which is where you point in, it's worthwhile to go more on the riskier side. But Deka is always defensive, so our riskier side is maybe more the conservative for the others.
Okay. Sebastien, for you, I mean, you're covering all sides of the risk. Is this correct? So how do you see that?
I think today, because of the macro uncertainty, and also, I mean, we haven't really talked about it, but the fact that, you know, real estate is, you know, is undergoing a number of structural shifts, right? So we've seen this, you know, coming to retail. Now there is a question mark about office, and, you know, at different point in time, like different asset classes are subjected to structural change. So there is a lot of uncertainty, and so it's a question of, I guess, what is your entry price and how the risk is being priced in a way. Today, we still find that probably, you know, maybe the risk premiums or the returns on the value add and opportunistic strategies, we struggle to find actually a large amount of opportunities where we feel that, you know, that we are well compensated for the risk, and therefore we keep doing those. But probably not in very large volumes, whereas maybe, you know, in sectors which are benefiting from some form of tailwinds, be it logistic, be it residential, you know, we, although the pricing is very, you know, is not cheap, certainly in today's environment, it feels like that the resilience and the sort of positive transformation the sector is undergoing, or momentum the sector is undergoing, is justifying to a certain extent, you know, paying you know, fairly full prices, and so we are active in those sectors.
Interesting to hear this from your view. Okay, maybe just to cover, we will also go to a Q&A session, but just on the debt markets. Germany is described as quite overbanked, and maybe this is also one factor why we get very cheap financing in Germany. And Sebastien, you're a very cash-rich buyer, but you use leverage. So why do this? How do you see the availability of debt, and do the conditions have changed much now?
Well, we indeed use leverage. We are not a very aggressive user of leverage, but we do consider that in today's environment, this is, you know, the low financing is in fact, you know, compensating for the lower growth that may be here for the years to come. And so we do try to take advantage of this. What we have noticed in recent time is that banks are becoming much more selective vis-a-vis the sectors that they are prepared to lend to, and the quantums of capital, right? So if you have a very large property, you know, very often now banks would have to create a syndicate to be able to lend, and in fact they wouldn't probably lend at the same level of LTVs as they would have been landing in the past. And if you have more secondary assets or if you have hospitality assets, I suspect that in today's environment, it would be very difficult to borrow, on those assets.
Okay. Yeah, a little bit a modern theme, but I think it's for all of you an issue you have to cope with. ESG, so ecological, social, and governance issues in your investment decisions. Would be very interesting to hear. What do you think about how is being put into your strategy for Germany, and what's kind of product in Germany, what fits best to this strategy? Klaus, do you want to start?
Yeah, in fact, ESG is one of the, when you ask me, it would have been the mega theme in this year when Corona wasn't there. And it would be overwhelming, maybe also even the Brexit. But it's still there as a very, very strong path, on a very strong path. And I think there's a point of no return reached. So of course our funds will look what is possible in the ESG theme, what is possible to look for proper buildings to buy, and maybe also to make a decision to sell some of the buildings which are economically in the old world still make sense to keep, but the new world, which is forthcoming, maybe makes no sense at all. So this is changing our reality in a strong way.
So would you then not go onto properties, for example, with tenants who are not ESG conform?
I think there are specific risks, and there are risks which are easier to address, like the economic environmental situation of a building. Towards tenants, it's a very, very risky thing to address someone as being ESG conform. Let's say Daimler, for example, who is also selling weapons on one of the sub firms. So what is that? Is Daimler a good tenant or is it not? So you have to be very, very careful what to address there. I think we start with the easy ones, and these are hard enough. And that these are already a big challenge, and we go on with the others, which are harder to make a definition. What we can say already is that we are rating countries, for example, for the whole ESG spectrum, but this is not so. Germany is a very good country in that matter, but other countries which we would formerly have invested are getting worse in this situation.
Okay. Ian, what is about you? I mean, you also have to fundraise, and it's probably a big issue for your investors. Yeah. How do you see that?
Yeah, absolutely. It's a huge issue. I think it's something which has been there for a long period of time. Maybe to Sebastian's point around some of the catalysts and structural trends which have increased over this year. Clearly ESG is one which has come more into focus as a result of COVID-19. In terms of how we think about it, it's really integrated in everything we do, and that's from the fund level down to the asset level. We actually at times keep it very simple when we're investing at the asset level. We either invest in very high quality buildings, or we invest in buildings which we think we can improve or know we can improve as part of our DD. So two very, very simple things. Agree with what Klaus said in terms of what the future looks like and people divesting, and we really have a very, very strong conviction that outperformance will be driven in the future by properties which are and investments which are in the right ESG sector. So be that by tenants, by the building itself. We're seeing at the moment, linking it back to some of the financing which you were talking about, we're actually seeing more competitive financing and lower margins where we're able to demonstrate that we meet certain ESG criteria. So it's often very difficult to measure these things, but there's a tangible measurement where, for example, we're getting a 10 basis point better margin on already extremely competitive terms. because we're able to meet certain criteria.
Okay, okay. And Sebastian, how is it incorporated in your strategy? You do it rather for your own funds, but does it play a role?
I think it's very similar to what Klaus and Ian has shared. I guess, you know, from a global perspective, Europe is probably one of the most active regions from an ESG standpoint, and I think that, you know, as you know, the other panelists mentioned, I think this is now flowing into the pricing. And so there is an acknowledgement that, I mean, not only we have our share of responsibility, but that the market will reward the people who are making this effort and participating in this initiative. So this is really affecting the way we look at our portfolio, and in terms of, you know, putting in place a framework to be able to measure anything from carbon footprint to other, you know, other type of metrics, and be able to either correct, invest, or, you know, take you know, or rotate potentially some assets. That has flown as well into our processes in assessing new investments. And there, you know, the framework is ever evolving. And then when it comes to investments and new projects or developments, I guess we are really trying to be at the forefront, you know, in order to be able to, I guess, you know, take a sort of leading role on the new products that we are investing in.
Great. Great. I think, yeah, we spoke long enough now. I would like to bring in the audience also to raise questions and give their a chance. Mr. Hilario, do you want to steer this with the questions?
Yes, certainly. Thank you for a great discussion round. I've received some feedback already. The first question was addressed to Mr. Williamson. Which peripheral or Eurozone countries don't have their risks adequately priced?
Oh dear, really being put on the spot here. Look, I think obviously every investor will have their own view on this. When you look at some of the macro levels, when you look at Spain and Italy, for example, there is clearly a difference in terms of the debt levels at the macro level versus Germany, France, and the Netherlands, for example. So, you know, you only have to look at that level, and then if you take an example of how people are investing on certain investments in those countries, there's not a big spread between what that investment price would be if you compare it to Germany or the Netherlands again. So, I mean, those would be situations where we would think very long and hard about if that, on a risk-adjusted basis, that is a, you know, a good investment and how you're looking at it. But I don't want to risk offending anyone if there are people from Italy or Spain in the audience. It's just obviously to look at those fundamentals and in particular the debt levels. I mean, clearly as a result of COVID, if your country is leveraged to that point, you have less ability to be able to react and to be able to deal with that.
Thank you, very diplomatically put. Maybe to open that question to the discussion round, would anyone else like to comment or confirm Mr. Williamson's standpoint? Mr. Abascal, maybe?
You're also looking at Italy and Spain, so how do you see that?
Well, I guess, I mean, the flip side of what Ian mentioned is that those markets are more subject to sentiment, and therefore, you know, we think that, you know, with advancing in this sort of difficult macro environment, there is going to be a repricing going on. Certainly, up to that point, I would probably agree with Ian that there wasn't much of a differentiation between some markets which are more vulnerable, maybe less deep and more subject to swings versus more stable and deeper economies. We expect this will probably come, and as a result of this, there will at some point in time probably becoming interesting investment markets.
Yeah, and I'd actually agree with Sebastian on that as well. If the point where they are priced correctly, then clearly they become more interesting.
And to add this, Ian, of course, we don't want to offend someone, but seeing the spreads, for example, from Italy and Spain, they are equally the same, but they are very, very close to the German government bond. There's very, very low spread compared to the financial risk. And I just can imagine where it comes from. Maybe there is an expectation of the future fiscal union, which might help these countries, and so there is a more balanced approach towards all European markets priced already in, which I yet not seen. I'm hesitate to see, but it might be that I get wrong, and then you are right again that the pricing, the future pricing, will show who's right. And if my skeptical view on this is too German, we might have a more European view.
Right, thank you for
Yeah,
that.
and that's a really interesting point. Obviously it was highlighted in the sovereign debt crisis a few years ago, but Dr. Becher, you make an extremely good point.
Just to make a standpoint on the discussion we had earlier on the participants being in a majority German, that's actually not quite true. Just to add that as information, I've had a scan through the participant list, and we can see from one further question, which is rather broad on the whole scheme of the European market as well. So one participant is asking what types of properties will suffer most in the aftermath of the current situation, and what strategies will you pursue? That being a more general question, maybe you can narrow it down to one or two examples. And Mr. Williamson, would it be all right if we would start with you again?
Yeah, absolutely. Obviously, I guess the first thing to say is it varies by strategy, so it will be slightly different between the core and the value add strategy. In terms of what we have been doing as a starting point and then where we're going, so for the core fund, we've invested in offices in logistics primarily. We are continuing to invest in logistics. We were already underway on our residential strategy. We're accelerating that, so that will be something which you'll see coming into the fund more in the immediate future. I think it's really interesting in terms of how things will evolve. Clearly, we don't have a crystal ball. We have our views on that. I mean, one thing which may happen is, for example, student accommodation. We're seeing some evidence that may bounce back very quickly. At this point in time, we're not investing in hotels. We have not invested in retail and won't do so. I think the one exception to that would be as part of mixed-use properties. So where, for example, in the heart of a city centre, you have some retail on the ground floor, maybe some offices above, and maybe some residential above that. That's something we believe in very strongly as part of how people will leverage real estate on their daily lives. So hopefully that gives a short overview, but I think we have very strong convictions on some things we have strong convictions against, and some things at this moment in time we're not doing, but probably will be in the future.
Thank you for that overview. Would anyone else like to answer that question as well on strategies? I've got a few questions more, just bearing in mind with the time that we've got left, maybe quick statements on your end, and then I've got a question from Mr. Kadel. Who would like to start? Mr. Becher, Mr. Abascal?
I can just start on the sector specific discussion, but for us as a long-term buyer, it's less interesting of what is next in the next 12 months. There will be a recession. There will be some result of the recession in the markets. I think that's for sure. And if it's hit a bit harder or less hard, that is a management thing, asset management thing you have to accomplish. What is more interesting is which is the long-term impact on what we have here after the next 12 months, and will there be some more teleworking or home office? And I can find any obstacles or some obstacles for nearly each of the sectors we are investing in. So office because it's telework or home office, hotels because we don't know if we travel anymore, retail because there is the online bomb planning, and logistics because the pricing did explode in the last 12 months. But we cannot decrease our exposure in every sector. So we have to make some decisions, but we have to find closely which are the cleverer ones forthcoming after the 12-month period, because this is impacting our investors, since they are very long-term investors, more than the next 12 months.
Thank you.
Maybe quickly to, I guess, to add, right? So in terms of the sectors which are undergoing the most stress, I would say that the first one in our eyes is probably hospitality, because, you know, on top of the question of valuation, they are suffering from the problem of cash flows, that there is no cash flows because people are not traveling and there is no certainty as to when this is going to resume. So this is a sector which is going under tremendous stress, and this is a sector we think, you know, could be interesting for us. And so this is a sector we are looking at. The next one is retail, you know, partly because it's going to be affected by the macro environment, but also there is this, you know, question of internet penetration and how does retail needs to evolve. We've been very cautious on the sector for a couple of years now, and then it will be a question of entry point and maybe individual opportunities where there is an ability to do a counter-cyclical play by repositioning or repurposing certain centers. And so we will look at it, but very selectively. And then in the office sector, there is also an element of uncertainty, and there it's also quite early to tell how things are going to unfold. And so we are trying to be selective, you know, team up with the right partner, and we'll continue to invest in the space.
Thank you. I think what we can clearly see is that there is a strategy focus on the asset classes and the markets itself. Now, in recent times, we've all seen over the TV and the news that there has been a polarization in politics as well. Clearly, that's not always part of an economic strategy, but it seems that with politics going back into the black box, that might be a very big advantage for the German market. And this is zooming in now. And my question for you, Mr. Kadel, does the German market actually have an advantage because of its political stability that it's had so far and that it's providing with, and this is another fairly general, sorry about that, question that has come up, but is the appetite for grade B cities that is very particular to the German polycentric system as well in commercial office actually risen, and where is it lying at the moment? So question one, is the political stability helping Germany? And question two, is the polycentric ABC structure also helping, particularly how is the appetite in commercial office when you speak with your clients?
Yeah, I mean, I hand it over to the panelists. I think it's more important to hear from them than from me from the advisory side. But Ian, yeah, what's your view like?
Good dodge, Christian. So I think, you know, taking each in turn, you know, all things being equal, if you obviously have more political stability, then that's going to make it an easier place, shall we say, to invest and to price risk. And so yeah, stability in Germany is clearly a good thing. I mentioned the Netherlands earlier. You know, that's somewhere which also primarily has a lot of stability at the country level. So again, somewhere which is easier, shall we say, to price, I think. I think to the question around polycentric and where and how you're investing, obviously that will vary depending on each individual strategy. Now, I think the one thing I would say on this for us, we are cautious around some of the spreads between the best cities and down to some of maybe the second tier or even third tier cities. So, you know, we often have the debate of top 5, top 7 or thereafter. And I think at this point in time, where you need to be careful is if the risk on the, let's say, the top 7 or below, if that is being priced correctly and if that will remain. So for us, we have prioritized top 5 cities. That's not to say that we wouldn't do things outside of that, but in terms of where we're focusing and thinking, we think those are probably better risk-adjusted returns, even if on the headline level at some points the pricing may be more expensive.
Interesting. I mean, Klaus, on this one, you have a little bit similar fund, which also more focus on those big cities, but normally we could imagine you as with a German perspective, it's also good to go to Freiburg or to Nuremberg or something. How do you see that, especially the polycentric investment possibilities?
Yeah, in fact, I'm speaking here for the global funds. Now, our global funds are quite easy. They are top 7 for the global fund, and for the metropolitan fund, there is in fact only Hamburg, Berlin, Munich, and Frankfurt. So they are even more restricted. And what Ian says on that point is that we also feel that the margin between first tier, second tier, third tier are somewhat too close on some point. You are not adequately your return is not paying it out for the risk. So we would for the global funds we need the possibility of liquidity in the market, and this is only given in the biggest market, and the smaller markets are for these funds, but out of a specific investment reason, not in their scope.
Okay.
Yeah, and I think maybe just, sorry on that, I realize that we often kind of defer to talking primarily about offices when we're talking about this. I think if you're thinking about logistics maybe, which is more by corridors and by nodes, or in particular probably the other main exception is residential. So, you know, the comments I've just made really apply to offices. Will you see us looking at residential in some of those more second or third tier cities? Absolutely, because it's driven by different things.
Mm-hmm. Sebastian, do you look at those other cities apart from the big 7 and also for the other asset classes?
I mean, in residential and logistics, yes. What I would say, you know, to look back to the sort of political stability is that in the residential space, we have seen, I guess, you know, the impact of discussions about regulation, and we see that this is, I guess, a hot topic across, you know, most European market, and Germany, and in particular Berlin, has been no exception. So there is a bit of uncertainty there. So far, it has been confined to certain markets. But yes, so for residential, we are mostly focusing on top 7 cities, but we also have a strategy to look at more secondary cities. There have been a conversion in pricing, and so there is a question of, you know, at which point you are being rewarded for the return and for the risk you are taking, and we are very vigilant about this. And then in the office sector, you know, the more secondary markets are not as deep for us, and so although we always had an aspiration to be able to find attractive opportunities, as as returns have been drying out, and as those markets are not, you know, providing a lot of opportunities, we haven't been really successful at deploying capital in those markets.
Okay. How much questions do we have? Because we have to, in conscious of time, that we don't be stressed.
Yeah, you're completely right. I think we can dare one last one, and then I will hand over for you to wrap up the session. It's with investors, you've partly already touched upon this, with investors attracted to the overall risk profile of Germany, but the low yields in commercial sectors and residential, do you expect more investment in specialty sectors? You've touched upon student housing earlier. How do you feel about senior housing or maybe also healthcare investments? We've seen a rise in that. Maybe just a short opinion statement on that.
From our view, we are not investing in that, so we are out in that question.
So we think this is interesting, but yields have compressed as well in those sectors, unfortunately, and very fast. So we are looking at those, and we are looking to expand in those sectors, be it data centers, and all those alternative sectors, which were maybe, and healthcare, which, you know, a couple of years ago we were not so active in.
Mm-hmm. Okay.
And we're probably halfway between the two. So to Sebastian's point earlier about partners, that is the type of area we would partner with specialists. We're not specialists in senior living or healthcare or data centers. So that would be the area where we would partner and fund specialists to do so. I think you will see us invest in some of that, but we're very conscious around taking on risk in some of those areas as well.
Thank you.
Great.
Great.
So yeah, I think I would like then to finish it on this side. I think we heard some very interesting views from different angles on the German market. I think it came up that it will be a very active market in the next 12 months. Certainly also interesting to hear from an outside angle that risk seems to be, at least at the big seven, and some asset classes correctly priced in. And yeah, hope it gave you valuable insight, the audience, on how to invest in Germany and what to sell, what to buy. Big thank you for the panelists, definitely. Claus, Sebastien, Ian, it was great that you could participate here. Thanks very much for that. If for the audience you're interested in our new edition of the Buyer's Guide, please contact us, likewise, to support you on any transactions. So thank you very much for participating. It was very interesting also for me. Please stay safe and healthy.
Thank you very much from our end as well. Nice afternoon and a nice weekend. Bye.